Welcome to the Cresco Wealthcast. My name is Dimitri Korolis. I'm the host of the pod, and I'm also an advisor within the Cresco Wealth Management team. Just want to say a quick thank you to all of you that continue to support and follow the channel. I appreciate you, and of course, welcome back. And if this is your first time to the podcast, thanks for stopping by, and I hope you enjoy. At the Cresco Wealthcast, the inspiration was very simple. I wanted to bring topics that were derived from real conversations, and I wanted to do it in a way that was relevant and relatable to you. And a lot of the conversations and the content that you're going to hear, it's coming from clients, it's family, it's friends, it's just being out and about and having those real conversations. Nonetheless, I hope you enjoy, but before I let you go, just want to let you know you can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. Until then, enjoy the pod. Oh, and by the way, that music you're hearing, that's Pete Ems. He's one half of Small Town DJs, and it was nominated for a Juno Award. He's on the team. No big deal. And welcome back. As promised, if you heard our last episode, we were doing another two-part series just because there is a lot of content to cover. What is that content? That content is in regards to family law and how it relates to corporations. So we want to welcome back, although technically, cat's out of the bag, no one ever really left because we've been sitting at the same table. We just put it in 2 episodes. But again, I want to introduce Abram Averbach, ABA Family Lawyers. You're the owner, you're the founder. Congratulations again on the new practice, and it's awesome that things are going well. And senior financial planner Wayne DeBoer, part of Cresco Wealth Management. Myself, Dimitri, one of the advisors on the team. But we teased it in the last one, but we can run through it again. Wayne, you had come up really with the itinerary for today, setting it up so that Abe can knock it down. Why don't you go through what we want to talk about today, and then we'll dissect it as such.
Yeah, sounds great. Thanks, Dimitri. In our last episode, we talked about some basics of family laws. They apply to family businesses, private corporations, things like that. And we want to build out on that a little bit today and figure out how sort of the nuts and the bolts, the finer details work when we start talking about, divvying up those interests. I mean, but there's also other layers to it too when it comes to things like support for a spouse or an ex-spouse, support for children, determining income, things like that. So I'm hoping that today we can dive into that a little bit, Abe.
Terrific.
So I guess let's start with that concept of income. I mean, one of the unique things about having a private business or a corporation, depending on how closely you control it, is you're kind of the master of your own domain when it comes to your compensation, salary, bonus, dividends, timing, how much, are you gonna, have CPP, are you not? There's all these things that you're in control of. And in my seat, when I'm doing financial planning with clients, we spend a lot of time talking about that. How do I want to control that within my company to benefit my future? But if you're going through a restructuring of your family, and now you've got to figure out how you're going to divvy up assets and support each other, it seems to me like things could get a little spicy in this situation if someone's been maybe taking a lower salary than they should have, or so how is income assessed in these types of situations, Abe, when someone does control their own salary, when they have control of the purse strings like that?
Right. So the overarching consideration is ensuring that all income earners, all payors of support, and I suppose all recipients, that the income is being determined fundamentally the same way. And so where you have an individual deriving their income from a private company and a company that they control, the question isn't so much how much income do they show on their T1, their personal income tax return, but how much income was available for support. That's really the question. How much is available? Now, if we contrast this with a quote-unquote regular employee, somebody who goes to work for a business every day and earns employment income.
Everything on their T4.
Everything on their T4, their income tax return likely shows 100% of their income available for support. But where you can leave money behind in the company because it's a preferable tax rate. What you've pulled out doesn't necessarily tell the whole story. So what we're instructed, and the good news is that income for child support, income for spousal support, same income calculation. We don't have, of all the ways that the law makes things confusing, this isn't one of them, that income is income in this world. So the first thing that we're looking at when we're determining determining income earned from a corporation, first question is, what is the income of the company? Revenue minus expenses. From that number, the question is all of that income available? Not should it be, not was it taken out of the company, but could it all be taken out? And the question isn't, could it all be taken out? Or if it was all taken out, would that have a long-term capital impact to the company? That's not really the question. Is, can the business continue to operate if all of that income was taken out? So if we use the example of a company that manufactures and sells t-shirts, or any company that has large inventory considerations, all of that income can't be removed from the company, or else that company doesn't have an ability to purchase its goods to continue operating. So maybe if the company shows $100,000 of income, perhaps half of that needs to stay behind. Maybe there are liquidity considerations on bank loans. Maybe there are other reasons why a business owner simply cannot access all that money. So that's the first question. What portion of the income of the company is available for support? So it's a tack-on analysis, right? If the T1, the personal income tax return, will show a certain amount of income. Then we're looking at the corporate income, and we haven't talked about dividend income. We'll get there. Then we're looking at the expenses of the company. And this is a really, oftentimes in the first conversation, it's a delicate conversation to have with business owners. Because what the child support guidelines say is that it doesn't matter if an expense is permissible from CRA's perspective. That expense may still have a personal component that would result in it essentially being added back into personal income.
Can you give us an example of that?
Perfect example is a telephone. Everybody runs their phone through their company because they can, and you should. Your private company should pay for your telephone that you use for work reasons. This analysis, though, from the support perspective, considers, well, what about that T4 employee? Right? That T4 employee is paying their $75 or $100 a month for their telephone in after-tax dollars, whereas that $75 or $100 is a pre-tax expense of the private company. So now we've got a differentiation in fairness. And so we'll look through, and typical places where you see this is, you'll almost always have telephone, perhaps home office is not a deduction. The case law says unless there is evidence that a larger footprint of home was necessary to be purchased for the business operation, that tax write-off, that home office, that's not a deduction from income. Perhaps some portion of travel, meals and expenses. Those are the types of personal expenses where there are personal benefits that otherwise would have been paid for in after-tax dollars. Those are essentially being added back into corporate income. That's a little bit of a simplified way of going about it, but that's essentially what we're doing, is we're kind of disallowing it as an expense only for guideline income. And the reason, and now nobody's cooked the books, nobody's done anything wrong. There are latent personal benefits that from a corporate expense and corporate tax perspective are perfectly permissible, that are not from a guideline income perspective. It is not a suggestion of wrongdoing. It's to make sure that person X who earns through a company is being treated the same as person Y who earns T4 income.
Can it get, I don't want to say attacked, or I should change the language. Can it get challenged if it's a retained earning? So someone says, you know what, here is the available income, but does it even out because now you look at the retained earnings on that side and then you can have that division of ownership, or how that falls down the pike, as you say? How would that work?
So that's a very interesting question, and this was actually under attack a number of years ago, and we ultimately the world was kind of restored, in that the way that we as family lawyers were doing things was eventually upheld. But where it gets particularly tricky is, well, if we're counting all of the income of the company as income available for support, first, what happens in a subsequent year when those retained earnings are being used, where you have a down year and now the payor is drawing into retained earnings, but they've already paid support on that dollar, right? So then what we typically as family law lawyers do is we say, well, that would be a double counting. Because so if the income of the company is $100,000 in year one, $100,000 in year two, and $20,000 in year three, and we've counted all of the $100,000 in year one and $100,000 in year two, if in year three that payor draws more than the income of the company because they had socked money away in years 1 and 2, well, for them to now pay support on that money in year 3 is counting the same dollar twice. So that's where some careful analysis of the retained earnings and the interaction goes. Where it doesn't end up coming up that much from a property perspective when we're looking at retained earnings and value or anything like that, because we don't have those support obligations historically. We just have data separation, retained earnings or X, and insofar as those are contributing to value, and this to value, then that's a property consideration. And this comes back to sort of the siloing off of income, the generation of fund, and property, the actual nut that exists there. So, but there is that careful interplay where if we're counting all of the money that was available in a year where there's an overdraw on money, we've got to be careful that we're not now double counting. But then on the other end of it, it's not always as clear cut as I'm making it be, because when you start thinking about things like support, now it's, well, why is the money, why has income gone down so much, and does that carry a corresponding fairness? So it's not quite as clear cut, but certainly we end up with a whole lot of considerations when prior year's income, where support has been paid on that money, is being accessed on a future date. You mentioned another area, and let's get into that. Dividends, bonuses, shareholders' loans. You touched on that, different distributable income. How is that managed when you're looking at things from your side? So the bonuses and employment income, I mean, those are largely going to be taxed similarly. Dividend income, what we're doing is it's a little bit more of a complex framework for it, where there's an adding back and a grossing up, where we're ensuring that, because if you have dividend income that on the personal level is taxed at a lower rate than income, because the corporation is paying some portion of that tax, we now again have that inequity between the income earners. And so it's essentially applying a tax rate and grossing money up to ensure that that from a gross perspective, everybody's income is being identically stated, no matter how.
So sorry to cut you off on that, do you look at it as a separate issue of availability?
On the dividend income, no. On the
dividend income, I should have specified, yeah.
On dividend income, it's a straight gross up to ensure that we're applying the right tax rate to that. there's, if you're going kind of more of a rough math approach, if you ignore the dividend, because the dividend is lower in the financial statement than the income is, if you, and this is less exacting, but if you're looking exclusive, if all of the income, if all of the personal income comes by dividend, then looking at the income of the company, you are capturing all of that available income, because a dividend is reflected on the financial statements lower than the income. So sometimes I don't look as far as, if I know it's all coming out by dividend, I'm perhaps really focusing on that, the income of the company, the corporate income. And then again, in expenses, if somebody is, perhaps you're structuring your income in a way, I want to take some salary so that I open up RRSP contributions, but I want to have dividends so that I could be lowering my personal income tax rate. On that blend, when I was talking about the add backs and the personal benefits, certainly an expense that is the salary paid to the business, to the shareholder, to the owner, that's going to be added back into the income as well.
Okay. That's interesting. So really what you're saying is, when there is a mix, you'll try to go back to the original nature of the income, whether it's a eligible, ineligible dividend, account for corporate tax, account for the tax credits, and things like that. No, that's great to know. So one other interplay we sometimes see is, families might get certain benefits, certain enjoyment out of assets that they have that might be owned by a corporation. Sometimes people will buy a boat or something like that using corporate dollars because it seems cheaper at the time. Looking back, or looking past the sort of shareholder benefits tied with that maybe shouldn't exist, do you account for those types of things as well when someone's got maybe personal use assets inside their corporation, or is that maybe a little too nuanced for the purpose of this conversation?
No, I don't know that it's nuanced. It's rare. It's a lot more rare. The CRA has really sharpened their pencils in terms of those allowances, which results in everybody's responsible accountants also sharpening their pencils. But one thing that we do, this is another area where concern gets flagged, is he or she uses their corporation as their own personal piggy bank, right? They run all of their groceries, all of their expenses through the company. And that's another place. So on the one hand, I was talking before about the personal expenses that someone perceives as suggesting that they're cooking the books. Then the other way is they're just routing all of their expenses through their company. Perhaps somebody doesn't have their own credit card, for example. It's just the business card and the personal credit card are the same. You're now interacting with the shareholder loan account. Now, it's perfectly permissible to do it that way, as long as those dollars are being considered not business use. So oftentimes we will see at the point of separation significant shareholder loan accounts. For example, if I were to run $100,000 of my personal expenses through my personal corporation, that is going to show as essentially money that I have borrowed. It's going to show as a shareholder loan, money owing from the shareholder to the company. And there's only a couple ways to deal with that. One is the shareholder pays the loan back.
Okay. Yeah.
Number two is a dividend is issued at the end of the year equal to the money that I borrowed. So it's papered as now my income. Or, well, I guess those are the only ways to deal with it. Or if you don't deal with it at all, it is then drawn into income by CRA's rules at the highest tax rate. So that again, that it feels like it's something that's improper because it is an obvious non-business use of business resources. There's nothing wrong with it as long as it's being reflected personally. But we often see people fall behind on those things. And now you've got a liability from the shareholder, and we've got to fix that through the issuance of dividends, or else there's tax liability.
Yeah. So shifting gears a little bit, Abe, in the last episode we talked a little bit about, coming up with the values of businesses, and I think Dimitri asked a question there about, maybe someone doesn't disclose everything about, what's going on in the business, or maybe they want to push sales out in the future. As it relates specifically to business owners and business families, disclosure, I imagine, is especially important when it comes to determining things like support and values. What are some of the especially unique things about disclosure in family law that apply in this situation? Like, are there different documents or the different details? Like, what has to be put on the table to make sure that everything is done fairly?
Yeah, so to put a definition to the term, disclosure is, in family law, disclosure is documentary production that for most families, it's a defined set through court documents. For most families, it gets us far enough along that we can help a family get to a resolution. So it's income tax returns and notices of assessment. Those sorts of things give us a picture of T4 or other income. It's bank statements, it's credit cards, it's mortgage information, investment statements, a net worth statement. It gives us all of that information that for the most part gives everyone an adequate financial picture to understand the landscape and to get to yes on settlement. When it comes to a corporation, first of all, an individual who owns more than 1% of a private company has an obligation to produce financial statements for the last 3 years. When it comes to income, we have case law in Alberta called Cunningham, and this is all coming back to what I was talking about before about personal expenses through the company. So a shareholder of a private corporation under the Cunningham analysis has the obligation to produce enough information that the other party can examine and can ascertain whether or not there are personal expenses latent in any of the otherwise perfectly allowable corporate expenses. So from a disclosure perspective, strictly speaking, it's financial statements. Practically speaking, I'm always asking my clients to send me their general ledgers that show me all of the entries under each of the expense categories. And what I like to do is, because transparency is key, and transparency is especially key when trust has been diminished, which it always is in the event of a relationship breakdown. Even the best, even the most amicable, there is still a degradation of trust. So what I want to try to do is answer questions before they even get asked. So I like to send in that opening disclosure. Here's the general ledgers for 5 years of the company or for 3 years of the company. Here is absolutely everything. You can now look. You can see how often this person went to Arby's or McDonald's or what they, under automobile, that what it all related to. Meals and entertainment, you can see exactly where this person traveled. Any of those things, let's answer all those questions. And that is the payor's obligation, because absent the provision of that, you now risk an inference from the court that says, well, you didn't tell this other person, you didn't give them all the information because there's something in there that's prejudicial to you. So you risk what's called a negative inference, where the court concludes that had you produced this information, it would have been prejudicial. So they ding you for the prejudice anyways. So better to get out in front of it and provide that information.
Yeah, in your experience, what's a document, and we'll take the high road on this one, where maybe someone's not malicious in not providing it, but it tends to just get overlooked? Like, what do you slap in your wrist? What, with clients, you're giving them the slap on the wrist and saying, hey, is it the expenses? Is it agreements?
It's probably not a corporate document. I think the document that is most problematic when it isn't produced right at the outset are any sort of loan documents for money borrowed from family. That what I would say is the most caustic of the you didn't get out in front of this one.
Right.
Obviously,
That's what I was trying to. Yeah. Thank you.
Obviously, the bank account in the Cayman Islands, that's a bad one too. But
Sure.
But generally speaking, because money that is provided from family, if one thinks that was a gift and that was actually a loan, and there's actually documentation that establishes that as a loan that was prepared at the time the loan was made. Sometimes where people fall down is in failing to produce that type of information because it's suspect, right? If there's been a loan received from one party's parents, for example, let's say to help purchase a house, it's for the down payment, and the other party thought that was a gift from the parents to both of them. That's now equity in the home that's shareable between the parties. And now you've got, after the fact, you've got a loan document that's coming out that suggests, no, that's money that is owed back to my parents or to your parents. It's highly suspect. And so the failure to produce that, even when it happened, but the failure to not get out in front of it following a separation is a problematic one.
I know Wayne's got a question on deck, but really quick, cross-border jurisdiction, is that a separate podcast in its own?
Cross-border jurisdiction is a separate podcast on its own. But largely speaking, I mean, what we would do in Alberta, if we've got our assets largely in Alberta, and then we've got whatever it may be, business interests or bank accounts down south, we're trying to treat them largely the same. We're trying to fit them into the way that our world works, but we're now having to engage, some tax experts who have cross-border knowledge to help us understand what's the actual value of this once we wrestle it away from Uncle Sam and into the hands of Uncle Mark Carney or that sort of thing. What are the tax ramifications of repatriation?
Perfect. Thank you.
Yeah, I think that was helpful there, Abe, just about the disclosure requirements and getting transparency. It was kind of like when you were talking about bringing out the general ledger, the GL, to sort of confirm stuff. It brought me back to like the whole, trust but verify quote from Reagan, right? Like, so we want to trust that, we're being forthcoming.
Be careful citing Reagan right now. Some national level economic issues. I don't know who's listening.
I don't think anyone's turning this into a video.
Yeah, we like the hashtag controversy. Yeah. It just gets good clicks.
We'll watermark this thing so that Rob Ford can't use it. Doug Ford.
Yeah. So that being said, let's say someone has brought their books in and you still can't sort of make sense of it. It just kind of shows that they're making $50,000 a year, but they're driving fancy cars, living in fancy neighborhoods, and you just can't reconcile it for the purposes of like support calculations. Do you ever end up like imputing income? I know that, like, for example, when it comes to tax planning, CRA can do like a bit of a lifestyle assessment of how people live and impute income based off that. Does that exist in your world in these types of situations?
It does in different contexts. So we will, where there is some concern that dots just aren't lining up. This person's showing $50,000 of income, but they're clearing $100,000 of after-tax payments through their credit card each year. I can't find where it's coming from. We're missing something. Something isn't there. That's where forensic accounting can come into play and be very helpful. There are some valuators in town who have the forensic background, and that can be helpful. That comes into a guideline income analysis, yes. And so where you've got, our test for imputation of income under the child support guidelines is whether or not somebody is unemployed or underemployed for the reason of diminishing their support obligation. So the imputation it's not so much an imputation in the family law world in this circumstance, so much as it is a spending analysis, like you said, that CRA would do. So it doesn't matter what this person's tax return or corporate income looks like. We can show that this amount of spend is the average spend, let's say, for over the last 5 years. That's what income should be, because it's identifiable. Neither their financial statements nor their tax returns are showing that, but it is not showing, those documents are not showing a number that is properly commensurate with the spending. Same as if we have somebody who is, for example, earning income in a tax-free jurisdiction, like maybe UAE or somewhere in the Middle East. We're taking their income, but we're looking at that as saying, okay, if they earn that in Canada, how much on a gross level did they earn? So we're adding income because it's an inappropriate number. Yeah. Wow. And same if you're an individual who doesn't pay tax in Canada, it's the same analysis.
So, talking tax, let's kind of land this, because I had a couple tax questions too, and I mean, just
it's going to get me in a lot of trouble. Let's go.
Keeping in mind that none of this is official tax advice, everyone should talk to their accountant and things like that.
Luckily, no one's listening. This is perfect. Thank you, Wayne. I appreciate where you're going here.
Beautiful.
But when we start looking at, dividing corporate assets in these types of situations, like, do you find that there are certain tax traps that maybe, clients can get caught in without realizing it, maybe, on dispositions of property or anything like that? Is there anything that people need to really look out for or structure deals around to minimize the likelihood of negative implications? What are some things you've seen there?
Well, so the first question, one structure that we use with a lot of regularity is when we've got a corporate asset level that can justify the transactional cost, we use what's called a butterfly transaction, which is a related party transaction that allows for assets to be moved from company one into the related party's new company on a tax deferred basis. Because and so what that does is it allows, for example, if we have a company with $1 million in it, we can move $500,000 into the new company, and now both parties have 50% of the assets to deal with them the way they want. There are going to be costs, there's going to be tax on disposition, on withdrawal, but each one now, without there being a disposition at the transactional level, each one has now gained control over their asset base. Where we've got a company that perhaps doesn't have that kind of sufficient heft to justify the transaction, well, now we're going to have to look at how we get the money out. And so the first way to get the money out is to just take it all out. That's going to attract a certain level of tax. Maybe we want to be staging the withdrawals to try to minimize the tax burden on those. So there are always tax considerations when we're dealing with a tax deferred transaction. Certainly we're wanting to take into account capital gains if there are any tax pools, anything else that is of value or is of negative value, so that we're allocating it properly. That's at a level now where one of the really interesting things about being a family lawyer is that you end up playing quarterback or project manager sometimes. So perhaps we've got our tax professionals to help us structure this agreement. We've got our valuators who are defining what the value of the asset base that's going to be spun. We've got our forensic accountants who are digging to find that bank account in the Cayman Islands. And all we've got in the middle is this lone little family lawyer who knows just enough to be dangerous, but we're learning, but we're coordinating the professionals. And so very quickly, the family lawyers will identify, okay, our end product here is a butterfly transaction, because let's say we've got $5 million of asset. We're going to pay 48% tax on a lot of that if we're going to actually withdraw 50% of it. And so that's just a non-issue right out the get-go, and it's something that can justify the cost. And so we've got a number of really great corporate lawyers around town who we work with in family law with regularity, who are terrific at structuring these deals. And so that's just some of the partnerships and relationships that we build in this business.
And just as a quick aside, for anyone who's wondering why we call it a butterfly transaction, it's just because at the end of it you have the symmetry of both sides of a butterfly, so it kind of resembles itself on both sides. You referenced something there in your explanation, Abe, about looking at like tax pools and things like that. This might be getting a little bit, a little bit nerdy for some, but it's something in my world that I do a lot of planning around. Is how do we make use of some of these tax pools in corporations, especially when we have professional corporations. We've been using them to sort of build up wealth as part of our ongoing plan. How do you make adjustments for those sorts of things? So, there's, and I won't get into all the specifics of it, there's refundable taxes, there's, capital dividend accounts. I think we have some podcasts on those topics. But, do you make adjustments for that when you're determining values? How do you look at those things?
Well, so it depends what we're doing with some of those pools. If we are dividing them equally, then no problem. Then we're gonna try to spin some of the refundable taxes, as part of the transaction. If one party is retaining them, or if, for example, a party is retaining some latent capital gains that perhaps aren't going to be, that may or may not be dealt with through various other pools. Now we are accounting for them, and so where we're really relying on, as part of our analysis there, is we're on those other professionals who are quantifying those and showing us what is there. Maybe we got some capital losses, which is something that you would hope would always jump out right on paper, because those can have, the missteps along the way can still pay their benefits in the future. And those are things that are absolutely considered property that can be shared. And we would want to, certainly if I'm advising on, call it the non-operational side or the non-business side of the transaction, the side that's receiving the butterfly amounts, I'm wanting to make sure that if there's some funds that can come out on a tax-free or a tax-limited basis, that we're either getting value for that or we're actually getting those abilities equally on our side.
That's why you're the monarch of family law, my friend. There you go. Do you see what I did there?
I do. I
see
like
what
that.
I did? Okay.
Oh.
I can contribute. Barring any other questions, something that came up here, I'd like to do this on a separate podcast and maybe go through your experiences. But as we're talking tax, financials, crypto, I'd love to know.
Crypto's interesting.
I'd love to know the crypto, and I think we should do that on a later one. But that one jumped out at me as well. Wayne, do you have anything left on your side?
No, I think that's it for me. I really just want to thank you, Abe, for joining us here today. I know you've been a friend of the podcast for a while now, and I'm always appreciative of the time you share with us, just to try to dig into some of these topics.
Yeah.
Some are generally of interest to everybody. Some are a little more nuanced, maybe like this one is. But thanks so much for your time today.
No, it's my pleasure. And thanks for having me, guys. It's great to see you both, and I'm happy to come back anytime. Thanks for having me today.
Yeah, no, this is great. And I'll give you one plug too. And one thing for everyone listening is we can work these a lot of different ways. And so for someone listening saying, you know what, I could use Abe's services or even have that discussion, you're always more than willing to do them together, do them separate. We get involved at different stages, however it looks like. So you can get in touch with us here at Cresco, or we have your information on every podcast if you want to reach out to your team as well. But yeah, we appreciate it. I do want to do the crypto one because I think people have that appetite for crypto as well as, and it may tie in with that cross-border jurisdiction.
Sure.
Yeah, you're great. I'm just trying to get excuses for you to come back.
Just the invitation. That's enough.
That's
I'll
it.
be here, Dimitri. Thank you.
Yeah, and we'll end up learning more about how many more people we know, and
That's right.
together we got to be good people around here. Cresco Wealthcast, again, it's on Spotify, it's on Podbean, and we will have the links for all the information. But thanks for joining us again. Hope you enjoyed the episode, everyone. Thanks for stopping by. Please feel free to leave your comments, or even if you want to let me know topics that you think I should be talking about. You can find us on LinkedIn, Facebook, Instagram, and YouTube. Just search at Cresco Wealth Management. And last but not least, if you want to be up to date with our newsletters, our insights, and even our events that we host throughout the year, you can reach out to me directly. It's pretty simple. You can just go to our website, find me from there, crescowealthmanagement.com. Thanks again, everyone.